What's the first thing that comes to mind when you hear the word recession? Headlines are rife with talk that a recession will soon hit the US. We've seen the economy contract over the last 2 quarters, which many say signals a recession. Inflation remains painfully high, and a growing list of tech companies are laying off employees and placing a freeze on hiring. This is a result of pandemic-driven overstaffing and growing uncertainty about the future state of the economy. So are we in a recession? Well, a majority of Americans think that we are. According to the latest IBD-TIP Economic Optimism Index, 62% of Americans now think the US is in a recession. This is up from 58% in July, 53% in June, and 48% in May. But what are experts and economists saying about it? Hi, I'm Matt, and welcome back to the channel. Today we are going to talk about the growing recessionary fears in the US and whether we are indeed in the midst of an economic downturn. But before we dive in, if you are new to the channel, please consider liking this video and subscribing so that you'll get notified whenever we release a new video. So before we can figure out if we are in a recession, let's first define it. The US Bureau of Economic Activity, or BEA, defines a recession as a market slippage in economic activity. A common interpretation of this is 2 consecutive quarters of negative GDP growth. Now, recessions are a normal part of the economic cycle, and they can be caused by several factors. These can include an overheated economy, a bursting of asset bubbles, and economic shocks, all of which seem to be happening to some degree. When a recession finally hits, the economy typically loses jobs and unemployment rises. Wages stall and both businesses and families stop spending so much. But the BEA notes that this identification of a recession, 2 consecutive quarters of negative GDP growth, is not an official designation. Only the National Bureau of Economic Research, or NBER, can officially determine a recession, which it hasn't done yet. The NBER is a private nonprofit research organization, and it's been the official arbiter of recessions going back to 1978. But here's the problem. It wasn't until June 2020, several months into the pandemic, that the NBER officially determined that the US economy had reached a peak just a few months prior in February. This peak marked the end of an expansion that began in June 2009 and the beginning of the COVID-19 recession. And it wasn't until more than a year after the economy bottomed in April 2020 that the NBER made its official determination that a trough in economic activity had indeed occurred in the US economy. The NBER emphasizes that a recession involves significant decline in economic activity that is spread across the economy and lasts more than a few months. It looks at depth, diffusion, and duration of the downturn, but it also looks at other measures of economic activity other than just GDP. These include real personal income less transfers, non-farm payroll employment, and employment as measured by that household survey conducted by the Bureau of Labor Statistics. It also looks at real personal consumption expenditures, wholesale retail sales adjusted for price changes, and industrial production. So while the NBER doesn't recognize 2 straight quarters of negative GDP growth as automatically meaning that we're in a recession, the last 2 quarters of GDP decline could signal that one is quickly approaching. Every time since 1948 that GDP has fallen for at least 2 consecutive quarters, the NBER ultimately has declared a recession. What's happening now? Second quarter GDP fell 0.9% according to the BEA. That comes as GDP fell by 1.6% in the first quarter. GDP is the monetary value of all finished goods and services produced in a country during a specific time period. And it's calculated by taking the sum of the following: consumption, or private consumer spending within a country's economy, private domestic investments spent on capital equipment, inventories, and housing, total government spending, and net exports. A drop of 0.6% marks the second straight negative quarter of GDP growth, a traditional definition of a recession. Though it probably doesn't help that we're coming off a year of the strongest economic growth since 1984. So why is GDP falling? Well, a few factors are contributing to the contracting economy. According to the BEA's GDP report, consumer spending has been slowing over the past 2 quarters, growing 1.8% in the first quarter and just 1% in the second. Business investments and the housing industry also slowed dramatically in the second quarter, further fueling decline in the GDP. Now, consumers are still spending and businesses are still investing, just with more caution as costs remain elevated and interest rates begin to climb. Inflation is at a 40-year high, culminating from a pandemic-driven imbalance between supply and demand and the war in Ukraine, triggering a sharp rise in global oil and food prices. This is likely why many Americans feel like we're in a recession, even if we aren't officially in one yet. Gas prices, though they've come down over the past couple months, are still way up and near their highest levels going back 28 years, according to government data. Gas prices are falling for a few reasons, one of which is that fewer Americans seem to be buying it. That's supply and demand. U.S. demand for gas is slightly down compared to last year, and higher prices are partly to blame. A March survey by AAA showed that 3/4 of respondents said that they would need to change their lifestyle to offset surging gas prices if prices were to reach $5 per gallon. And 80% of those who said that they would need to make adjustments in response to higher gas prices said that they would opt to drive less. Well, the national average jumped over $5 just a few months later in June, and prices are still hovering around the $5 mark in some states. Despite 2 consecutive quarters of negative GDP growth, high gas prices, high inflation, and rising interest rates, and a growing number of companies turning to layoffs and hiring freezes, many experts still say we actually aren't in a recession yet. This is because the overall labor market remains strong, as does consumer spending, even in the face of rising costs. At 3.7%, the unemployment rate is around the same level as it was before the COVID-19 recession began in February 2020, and it's around its lowest levels since at least 2002. And many of the layoffs that we've seen throughout the tech sector are a result of the overhiring during the height of the pandemic. Looking at job growth, the U.S. economy added 315,000 new jobs in August. This is down from the 528,000 new jobs added in July, but it shows that companies are still hiring. Then there's consumer spending, which is holding up despite higher costs. Jeffrey Roach, the chief financial officer for LPL Financial, told Forbes that this type of job growth typically doesn't coincide with a U.S. recession.
We are not in recession yet. Consumer spending was too strong to raise any recession signals in Q2. Consumers shifted from buying goods to buying services, and after adjusting for inflation, real consumer spending rose 1% annualized from the last quarter.
And consumer spending accounts for roughly 70% of U.S. economic growth. Americans are undoubtedly spending more now to buy the same amount of stuff. That's inflation at work. But that they're continuing to spend despite rising costs could be a signal that we're not yet in a recession. Retail sales tend to decline during recession as people have less money to spend, and that's just not what we're seeing right now. So while GDP might be declining, low unemployment and strong consumer spending seem to be what is keeping us out of a recession, for now at least. What does this mean for you? Or what can you do about it? According to Alliance Life's recent quarterly market perception study, 65% of Americans say they're just too nervous to invest right now because of the possibility of a recession. Moreover, the number of Americans who think now is a good time to invest continues to decline. While many investors are rightfully worried about their declining portfolios, removing yourself entirely from the market could result in you missing out when the market unexpectedly rebounds. Data from Putnam Investments shows that missing the market's best days can result in a significant lost opportunity. Having $10,000 invested in S&P 500 between December 31st, 2006 and December 31st, 2021 would have resulted in an investor earning $24,753 more than someone who missed just the 10 best days during that time period. A tumbling portfolio is hard to stomach, so here are 3 investment moves to consider as recessionary fears mount. Number 1. Sharp declines in share prices of solid companies may actually present good opportunities to invest at lower prices. Number 2, diversifying your portfolio with stocks of companies in sectors that tend to fare well during recessionary times may provide a backstop against losses. And number 3, a solid emergency fund or cash reserves will help prevent those near to retirement from selling stocks at a loss to cover expenses. So are we in a recession? Well, the signs are mixed. Some say that we are, or that one is at least right around the corner. To many Americans, it sure feels like it, and that might be all that matters. Well, that's it for today. If you like this video, please subscribe to the channel, and we will see you next time.